Welcome everyone. We'll now continue with our discussion of a very simple example of how you can use MATLAB to calculate a present value and to evaluate a stream of cash flows. And later on we'll start with portfolio theory, but to get you back into the subject, let's just see how we can apply MATLAB or use MATLAB in a slightly more applied way and applied setting than in the last lecture. So we'll start with a very simple financial instrument, a coupon bond that pays out here in this case a coupon of 8%. You will have a notional value of 100, so you would pay a price P, and you will get 88888, for example, every year. And then in the end, you will get a notional value of 100 plus the final interest payment of 8. Why is it 100? Well, it's standardized, and if you, for example, were to invest 1 million, you would simply have to take this 100, 108, 888 times 10,000. So you would buy 10,000 bonds with this notional standardized value of 100. By the way, if you ever take a newspaper and look at the bond prices, for example, in the Frankfurter Allgemeine Zeitung, in the business section of a newspaper, they will also give you information not just on stocks, but sometimes also on bond prices. And with bond prices, you will also see prices that range somewhere between 100 and say 125 to 122 or something like that. And these are obviously prices for bonds that have a notional value of 100. And interest payments, the coupon payments, are standardized on this notional value of 100. Okay, so we'll have a cash flow 0, 8888, 108. And we'll write a function for the calculation of the present value of this series of payments. And that's quite simple. If you haven't noticed in MATLAB, if you want to define a vector or a matrix, it's quite simple. You will have to put it in brackets. And if you were to insert a comma in this vector, you would create a matrix. So 1 space 2 space 3 comma 4 space 5 space 6 comma 7 space 8 space 9 bracket would define a 3 times 3 matrix. And this is a one-dimensional vector here. So if I were to enter a comma here, you would create a matrix, and this wouldn't work because then you would have 1, 2, 3 entries in the first line and it would work 1, 2, 3 entries in the second line. So this would be a 2 times 3 dimensional vector, matrix, sorry. Okay, but this is a vector, and let's now calculate the present value. We'll define a function, my PV var. This here is the name of the function. So every time we type in my PV var, it will open this function. This here is the output. So function tells MATLAB what now follows is the definition of a function. My PV var is the name of the function. PV is the output variable, and this is the input variable 1, and this is the second input variable. So I'll insert CF and R in the function my PV var, and as an output I will get PV. As you might know from simple programming languages, it doesn't matter that your input has to be called CF or it has to be called R. If you were to insert any matrix or vector or number here, the function will try to work with CF and var and will just rename the input variables you've given to the function as CF and as R in the function. And the output will be PV. So what do I do now? By inserting a percentage sign in front of a line, this is just a comment, so the program will skip this line but for a better understanding of the program, we'll have this comment here. We'll get the number of periods. In the third line, it's n equal to length of CF. Length of a vector is obviously the number of slots in the vector, in the entries. Fourth line, again, a comment. Determine the vector of discount rates. df is equal to 1 point dash 1 plus r point, and then it's taken to the 0 up to the n minus 1 power. And this is a little bit MATLAB syntax. First of all, if you were to use a plus b, it's a simple sum of a and b. But it could be that a and b are vectors. And if I were to take a times b, and a and b are vectors, now two things could be done. If it's a vector like this, or two vectors, then obviously the product of the vectors will be the scalar product, and it will be a real number. But I could also, and this would only work if it's a 1 times 3 and 3 times 1 dimensional vector. But I could also be inclined to calculate the following. If I were to take 1, 2, 3, and 2, 2, 2, I could also ask MATLAB to calculate 1 times 2, 2 times 2, 3 times 2, and I would get this new vector. So if I want to calculate calculate the product of two vectors or two matrices element-wise, I will put a small dot in front of the operator. And this is what is done here. 1 plus r could be a vector, and I don't want to calculate 1 divided by a vector, but I want to create a new vector, 1 divided by the first entry of the vector. The second entry of the new vector is 1 divided by the second entry, so this calculation is done element-wise. Same here. I don't take I don't take it to a vector power. It's not defined. But if I have, for example, one interest rate r, I want to calculate 1 divided by 1 plus r, 1 divided by 1 plus r squared, 1 divided by 1 plus r taken to the third power, and so on. So the result should be a vector, and that's why every operation is done element-wise. That's the only reason I have this little dot here and here before the operators dash and this power operator here. And this here simply means what? 0 to n minus 1. So it will be 0, 1, 2, 3 until n minus 1. So this here will be a vector. And that's why I need to calculate the rest of the expression element-wise. And then I'll calculate the present value, which is very simple. Dot is the function in MATLAB that calculates the scalar product of two vectors. So I'll simply take the cash flow vector times the vector of the discount vectors, and the result obviously is the present value. And that's PV. And this is only the definition of the function. I still need to call the function. That's what I do next. Again, my calendar. So we're going to determine the internal rate of return. And for this, we assume that the series of payments, the nominal value is 100, quite clear. The internal rate of return, in German interner Zinsfuß, is defined as the interest rate R that gives you a present value of 0. So that's the present value here. And if you have a present value of 0, the interest rate with which you are discounting is the internal rate of return. So we define the internal rate of return in this way, and we are now trying to find the internal rate of return of this bond, more or less. And we are using the roots because, as you can see here, we need to find the zeros or the roots of this expression on the left side. And MATLAB can do that with roots. Small problem. We have a cash flow stream that looks like minus 100, 888, 108. But as you remember, polynomials in MATLAB are defined as vectors of coefficients starting with the highest power of x. So it will not look like this and so on, but actually polynomials are written as in this form: plus x plus 0. So we need to flip from left to right the vector. That's done here. Zt is given by the roots, the zeros, of the cash flow vector, flipped from left to right. Again, what does this do? It flips the cash flow vector. Roots takes a vector and assumes that the entries in this vector are the coefficients of a polynomial, and it solves for the zeros of this polynomial. And then we'll get these results. As you can see, all of these results are complex numbers with one exception, and that's 0.9259. I told you last time one should be very careful when neglecting and when discarding complex solutions. In this case, it is quite clear that this is the only solution we need. This is the only real solution, the real numbers. And as you can see, the internal rate of return is, obviously this is not the rate of return, this is the discount factor. If you invert the discount factor, you get 1 plus r, the internal rate of return. And surprise, surprise, it's 8%. Obviously, this is no big surprise, because if you pay 100, it pays you 8, 8, 8, 8, and 108. The internal rate of return obviously is 8%. Now, this will not happen in practice, obviously. This is the idea that you pay 100 for the bond, you get 8% coupon fixed, and then you get the full repayment of 100 plus the 8% interest. When you have a look at the business section and the financial market section in a newspaper, you will rather see what? You will see prices like something like that, 108.23. Why is there a difference between a price of 100 and the notional value of 100 and the market price for such a bond? By the way, there was a newspaper article yesterday that discussed this. Some company issued a bond. Well, a company issues a bond and it has to pay a coupon on its debt, obviously. It pays a coupon on its bond, and, well, currently interest rates are 0. But no one would give a company debt and capital as part of a bond for a zero interest rate. So they have to pay the risk-free rate plus a credit spread for the risk that the company may default on its bond. And then you will have an interest rate, and this coupon will be fixed. After some time, market interest rates and credit spreads could change, and market participants will react to this. A very simple example: assume that you have a risk-free rate of 1% and a credit spread of, say, 3%, so you will have a coupon of 4%. Now, if the company is close to default, what will happen? The credit spread will increase to, say, 20%, an absurdly high value, to 20%. Then what should you do? To calculate the price, the fair price of this bond, what would you do? You would take the fixed payments, the fixed coupon payments, 8, or in this case 4, 104, discount them with 20% interest rate or 21%. The present values of all these future cash flows will be very small. And what will be the result? You can buy this bond at a cheap price at, say, 20 euros for a notional value of 100. Quite clear, you would not pay 100 or 120 euros to get a repayment of, say, 125 in total for a company that is close to default. Yeah? Clear? Okay. So in this case, no big surprise. If I say, well, the price is 100, the notional is 100, and I have a fixed payment, coupon payment of 8 every period, the internal rate of return will be 8, because I'm discounting with 8% as well. Now, it gets different if we have a price. So, again, be cautious when thinking about discarding complex results and results in the complex numbers altogether. In some cases, this might be misleading. And I have one maybe pathological counterexample, but I think it's quite interesting to see this. Assume this very, very simple polynomial, x minus 100 taken to the third power. If you expand this expression, you will get x to the third power minus 300 times x squared, and so on. And you calculate the roots in MATLAB. So 1 minus 300, 30,000 minus 1 million, h equal to roots of v. And as you can see, the results will be 1 with a slight error, 1 plus almost 0 times the imaginary unit, and 1 minus 0 times the imaginary unit. So again, one would think, okay, I can leave out these roots, but no, the rounding error and the truncation error of this calculation leads MATLAB again to think that even though this is a triple root in the real numbers, MATLAB thinks that it can only solve this by digressing into the complex numbers. You know? Okay. So even with a very simple cash flow stream and a simple idea to calculate the present value, you can use polynomial root finders, and you will maybe get into some trouble, but it's just a small introductory example. Now let's turn to the second or the first real big topic here in this lecture, portfolio theory, and later on portfolio optimization and systems of linear equations. First of all, who of you has already heard a lecture on portfolio theory? Who is familiar with Markowitz, portfolio theory, capital asset pricing model? A couple of you. Okay, so you will maybe hear a lot of well-known facts, maybe something new, but you will definitely see how these theories and how these problems of portfolio optimization can be, or one can try to solve it in MATLAB with sophisticated algorithms. Now, we want to talk about portfolio theory, and what we are trying to do is not naive diversification, but a systematic look at how portfolios can be composed, how portfolios can be built to achieve a systematic diversification effect. That means a risk diversification, and ideally a better risk-return profile in contrast to simply putting all of your eggs in one basket, or naive diversification. Naive diversification would simply mean I have 10 assets and I put 1/10 of my investment sum into each of the bins. That is naive diversification. 5 stocks, 5,000 euros, 1,000 euro per share and per stock. That would be naive diversification without any idea where I should put more or less money. And the results later on will predominantly come from mathematical optimization. Optimization, operations research. Is everyone clear what operations research is? What it entails? It's just the intersection of especially optimization and business and economics. And that's what we are trying to do later on. But we'll start with Markowitz portfolio theory and later on the capital asset pricing model. So let's start with Markowitz. If you want to read a little bit more about this, you can take the textbook by Albrecht Maurer. Most of the things I'll be discussing here is taken from the Albrecht Maurer textbook, but you can find it in almost any textbook on finance and portfolio theory. So we'll start with our base model. That is, we have N financial securities. Could be stocks, could be bonds. I guess stocks is a natural choice because stocks are liquid, are highly liquid, and you don't have to be concerned about anything else than market price risk. So market prices will go up and down, and let's assume liquidity doesn't play any role here. We'll look at returns. Now you can make a big case out of the question whether you should use log returns, whether you should use discrete returns. In this case, we use discrete returns, diskrete Renditen, simply taken as price tomorrow minus price today divided by price today, with one slight change here. You might want to include a dividend payment, but we can also leave that out for the moment. So usually we neglect dividends, so it's simply price tomorrow minus price today over price today. Yeah? So the price obviously today is known, so risk only stems from the fact that tomorrow's stock price can change. Now investors in our base model assess the profitability of investments in a very simple way. They only look at the expectation, the expected value of the stock return and the volatility of the stock return. In statistical terms, again, expectation and variance or volatility. Erwartungswert, Standardabweichung, Volatilität oder eben Varianz. One quick reminder, in English, expectation sounds a little bit like prose. Yeah? I'm expecting something. But in mathematical terms and in mathematical books and articles, expectation is equal to the German Erwartungswert. You take the expectation means den Erwartungswert ausrechnen. So every time you hear take the expectation of X, it means the expectation of a random variable X. Just to be sure that you don't misinterpret this as some kind of vague verbal description, but actually we are referring to the expected value or the expectation of a random variable. So if two assets have the same variance, meaning you have the return R, you're calculating the variance of R, or taking the square root, aka the volatility of the stock return, investors do the following. If two assets have the same variance, and if they have the same variance, they will have the same volatility, they choose the asset with the higher expected return, and if the two assets have the same expected return, they will choose the asset with the smaller volatility. A very simple mu-sigma approach to decide on which asset to buy and which portfolio to buy. If we only had a lecture on risk theory, in German Entscheidungs- und Risikotheorie, you would learn a lot more about risk aversion, decisions under risk, Knightian uncertainty, and these things. Then I would tell you a little bit more about how one can define all these terms, how you can justify that, for example, risk-averse or risk-neutral investors will decide according to this mu-sigma approach. But let's just assume, as a given in this model, that investors only look for two things: expected return and volatility of the stock return. So the tradable securities we just assume, can be divided as needed, meaning that if you want to buy 2/3 of a stock, you can do so. This makes it very, very simple. And if you have ever taken a class on operations research and or optimization, you will know that it makes a huge difference whether you have continuous optimization or discrete optimization. Famous example, but very instructive example. If I want to pack my bag and I can divide anything that I want to put into my bag, I can quite easily maximize my utility. But if it's a discrete optimization problem, if I cannot cut this piece of equipment into half and still have the same utility or have the utility, the decision problem becomes almost impossible to solve, because I have now to decide, should I put this into my bag and leave a lot of space unused, or should I put something else in my bag that only gives me a smaller utility? So discrete optimization, in German diskrete Optimierung, with discrete choice variables is much, much more difficult than continuous optimization. So this assumption that we can divide stocks and assets as needed is a very crucial assumption in this model, and it makes life much, much easier. And in real life, obviously, we cannot buy half a stock. We cannot buy 1/3 of a stock. We only can buy 1, 2, or 3 stocks, and so on. So it's usually a discrete problem. And these securities cause no transaction costs. So I don't care whether I can buy or sell more or less of my stocks. I have no transaction costs. Okay. Now, starting point for the following idea on portfolio theory, as originally proposed by Markowitz, is the idea that the risk of a portfolio must always be equal or smaller than the sum of the individual risks, i.e., you have diversification. Now, by the way, for you, I hope diversification is a natural given, and diversification is immediately clear. I personally found out that if you speak, for example, if I spoke to my parents, if I mentioned just the word diversification, sometimes people who are not versed in economics and especially finance, they don't know what this is all about. Even diversification is a word sometimes people and laymen don't really get and cannot really capture. So diversification means we want to build a portfolio that has a risk that is smaller or equal than the sum of the individual risks. Because otherwise we could simply buy these isolated assets. Now, if the variance of the return rate is used to measure the risk, we know that the variance of a linear portfolio of these securities will be determined by the correlations between the securities. Why is that? Think of it like this. You have stock A or X and stock Y. How can you calculate the return? Simply by taking the product. I will buy A stocks of X and B stocks of Y. Now, if I take the expectation of this linear combination of two random variables, you know that what will result is A times the expected value of X plus B times the expectation of Y. For the variance, it will look slightly different. It will look like this, variance of A squared times variance of X plus B squared times variance of B plus 2AB covariance between X and Y. And you can see that the variance of the portfolio, this is the portfolio here, the variance of the portfolio will be determined by the variance or the volatility of the individual risks but also by the correlation or covariance between x and y. This is why we need to look at correlations, and this is why diversification effects are driven by correlation and dependence between the constituent assets in a portfolio. So according to portfolio theory, we're not primarily interested in naive diversification, but we are interested in exploiting this correlation structure between x and y in such a way that we can get a diversification that is even better and an even higher diversification effect than simply dividing our investment sum into n parts. So this is a targeted diversification we are after, and this is what the Markowitz portfolio theory gives us. Now, this diversification implies that a useful combination of single investments can reduce the volatility of the return of the portfolio in such a way that we can get below the risk of a single investment even. And later we'll see that uncorrelated investments contribute especially to a diversification effect. And as we are going to find out, a complete reduction to zero is almost impossible, at least without derivatives and in real life. But we'll see some cases what will happen if we have a certain correlation structure between x and y or a and b. So this is the first case of two securities, perfect positive correlation, aka the correlation coefficient is 1. Now what will happen? The second case is perfect negative correlation, meaning that A goes up, or in this case investment C goes up by €1, investment D will go down €1. So this is rho equal to -1. And this is the third case, somewhere in between, not a perfect positive or negative correlation. So it might be that they wander in line for some time and in parallel for some time, but then they also change again. Now, let's discuss this analytically. We start with two returns, R1 and R2 for two stocks or two securities. Share of security 1 in the portfolio is given by x, and x is between 0 and 1. Two observations are required here. First of all, why do we only use x as the share of asset 1 in the portfolio? What is the share of the second stock? Well, we want to have a nice and easy life, and we just assume that we are investing 1 minus x in the second asset. What does it mean that x is between 0 and 1? Yeah, but what does it mean practically for trading? Yeah?
You're not short selling?
Yeah, short selling is not allowed. If x were negative, it would mean that you are short selling stock 1 and you are investing more than 100% into stock 2. We could allow this, but not in the space model. And because we don't want to have very extravagant and very long notation here, we simply write mu I, mu1 and mu2 for the expected return of stock 1 and 2, sigma I squared for the variance, and mu pf and sigma squared pf for the portfolio expected return and the portfolio variance. Correlation is rho. We only have two stocks, so we only have one correlation coefficient, so that's just rho. And as you know, the value and thus also return of the portfolio is linearly dependent on the individual values. So we have the portfolio return equal to x times the return of stock 1 plus 1 minus x times the return of stock 2. The expected value then is x mu 1 plus 1 minus x mu 2. And, well, I've already given you this here, and it's no surprise that in this special case, you will have x squared variance 1 plus 1 minus x squared variance 2 plus 2x 1 minus x times, and now not the covariance, but this here is the covariance, correlation times the product of the two standard errors, the volatilities. So here you have the covariance between R1 and R2. So that's the portfolio variance. Now the set of all possible return risk profiles is given by the set of M of these different combinations of mu PF and sigma PF. As you might know, in financial theory and especially financial markets, it's often an interesting question whether the financial market is complete. What does it mean? Financial market is complete if you can construct any type of cash flow. Very simple example, if you only have two periods, t equal to 1 and t equal to 2, and you have two securities that offer you this cash flow, then the market that is spanned by these two assets is not complete. Because if I were interested in a cash flow like this, how would you construct 2 as a cash flow from a combination of the two assets? Spanning property, completeness of a financial market, as you can see, is closely related to linear spaces, so you need a base of the linear space to construct and to span the financial market. Here, it's something similar. We want to know which return risk profiles can we construct from combining these portfolios. For example, if I were to tell you I have one stock that offers you 5% with a volatility of 6, and a second asset that offers you 10% expected return, but with a volatility of 30, the question could then be, but can I also get a portfolio that offers you 7.5% return with a standard variation and a standard with a volatility of, say, 12? Could be that it's possible, could be not. So we are interested in the set of possible risk-return profiles that is spanned by the available securities. And then we know this is the set of potential portfolios, and we want to single out the efficient portfolios and then find the optimal portfolio. The set of possible return risk profiles, the set of possible portfolios, can be characterized in case we have perfect correlation, positive correlation. Now, if rho is 1, we can see that the portfolio volatility is given by sigma 2 plus sigma 1 minus sigma 2 times x, and the portfolio return is given by this expression. You don't need to memorize this. You can also simply calculate it. Just put a correlation of rho 1 into the general formulae, and then you can calculate this. And in this case, if rho is 1, you can easily see that this is a straight line with the mu sigma values of both individual securities as the endpoints. And this is shown on the next slide. You have stock 1 here and stock 2 here. If both are positively correlated, perfectly positively correlated, the set of portfolios is this line. Okay. By the way, you have sigma here and mu here. Second case, uncorrelated assets. For uncorrelated assets, you again calculate the portfolio volatility or variance, and we are now interested in the so-called minimum variance portfolio. How can you calculate the minimum variance portfolio? You take the expression, the formula for the volatility, and you minimize that function with respect to x. Take the first derivative, just like in high school, set the first derivative equal to 0, solve for x, that gives you the minimum variance portfolio. Very simple algebra. And here at the bottom of the slide, you can see we're taking the first derivative of the variance. We're setting it to 0, setting it equal to 0, and you get the sigma 2 squared divided by sigma 1 squared plus sigma 2 squared. And again, note that x has to be 0 and 1 for the two stochastic returns. And we now have the optimal x, or not optimal, but the x that will give you the minimum variance portfolio. It could be, for example, 25%, meaning invest 25% in asset 1, 75% in asset 2, and you will get the minimum variance portfolio. It will not be optimal, but that will be the portfolio that gives you the minimum variance. But we don't know yet what variance and what expected return this minimum variance portfolio will have. So what do? Simply plug in x star into the equation for the variance and for the expected return. So put it into the formula for the portfolio variance. You will get this, and you can also do it for the expected return. And the interesting result now is that we start by the minimum variance portfolio's volatility. It's equal to sigma 1 times sigma 2 divided by the square root of sigma 1 squared plus sigma 2 squared. And this is smaller than sigma 1 times sigma 2 divided by the square root of sigma 2 squared. Why? If you are studying or if you have studied mathematics, you know this. If not, this might be new to you. When dealing with inequations, it is slightly different than dealing with equations. With equations, you have to be exact. The left-hand side has to equal the right-hand side. With inequations, you can be a little bit coarse, and sometimes you can use a little bit brute force by just leaving out an expression, and it doesn't matter if the difference is small or larger as long as the inequation is fulfilled. And this is what happens here. You can simply say, well, I have a denominator here, and if I just leave out this here, well, the expression in the denominator will be smaller, and then this here is larger. So it's a very simple way of leaving out a part that may cause a problem. And if you look at this expression here, you will see, well, sigma 2 divided by the square root of sigma 2 squared, and it will just be sigma 1. And in the end, you can just neglect all this and this here, and you will see sigma MVP is smaller than sigma 1. And by switching 1 and 2, you can show the same for sigma 2, meaning the volatility of the minimum variance portfolio will be smaller, not equal, but really smaller than the volatility of asset 1 and asset 2. So if you have two assets with volatility 10 and 12, you can be sure that the volatility of the minimum variance portfolio will be smaller than both 10 and obviously 12. And you can reduce volatility by shifting to the minimum variance portfolio. We haven't talked one sentence about the expected return. And we would strongly assume that the expected return of the minimum variance portfolio will also be smaller if the variance and volatility is smaller. But if you're only interested in risk reduction, just go for the minimum variance portfolio. So you have a diversification effect. And now we'll talk about the special case of rho equal to 0. So no correlation at all. Again, we'll have a look at the functional expression of the expected portfolio return and the volatility. Again, you will see x and the MVP. Mu, the expected return on the expected and on the minimum variance portfolio, is given by this expression. Now, combined with the portfolio variance, we get this expression here, slightly reorder it, and you will see 0 is equal to x squared minus la 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 x plus la la la. And if obviously sigma 1, sigma 2, and mu1 and mu2 are known, this is what? This is x squared minus a times x plus b. And that's a simple quadratic polynomial expression, and you can calculate 2 roots of this. Okay. So the final result is x is equal to this. It looks difficult, but it's simply applying the simple PQ formula from high school to this expression with larger coefficients. And if you now plug it in into the expression for the portfolio return, this will result in this, and later on this, and this is the final result, and this is now interesting. The portfolio return on any portfolio is given by the expected return of the minimum variance portfolio plus minus this expression here, and it depends on the variance of the portfolio. If you are accepting a higher portfolio variance, your expected return will be higher. If you are willing to only accept a low level of portfolio variance or portfolio risk, then your premium, in addition to the return on the minimum variance portfolio, this premium will be smaller. This is what this expression tells you. And for the special case of no correlation, the graph, the plot of this sample space M is the right arm of a hyperbole that starts in the minimum variance portfolio and increases monotonically from that on. What do I mean? Well, you have the volatility here, the expected return here. Somewhere here you will have the minimum variance portfolio. And this will be this right arm of a hyperbole. And this is the set of possible solutions here. If 0, or if the restriction that x is between 0 and 1 is neglected, you will also have more combinations. And in the end, you will have something that looks like this. You have stock 1, stock 2. You will have the minimum variance portfolio here. And then later on, you will have this hyperbole here. If you have already heard a lecture on portfolio theory, you will immediately see that, well, we'll later on leave out this part. Why? Because those are inefficient portfolios. But the set of all possible portfolios is given by this part of a hyperbole. Last case, perfectly negatively correlated risks. Rho is equal to -1. We do the same thing as for rho equal to 1 and rho equal to 0. Plug it into mu PF and sigma squared PF. Again, the minimum variance portfolio is given by x equal to sigma 2 divided by a sigma 1 plus sigma 2. Portfolio risk can be completely diversified here, actually, and the portfolio risk is 0. And this is the x. And then we'll have this case. Stock 1, stock 2, the minimum variance portfolio, and these two lines that's M, the set of possible portfolios. And if you've now combine all these plots, what can you see? Let me just erase this again. For perfect positive correlation, you will start with a line between the two stocks. And by lowering the correlation from +1 to, say, 0.9, you will have something that looks like this. Say this is rho equal to 0.9. Something like this. Something like this. And in the end, you will have the case of -1, and then the two graphs will again be two lines starting from stock 1 to the MVP to stock 2. And interestingly, the minimum variance portfolio here offers you a full hedge or a complete risk-free investment. So ideally, as an investor, you would like to look for two assets that are perfectly negatively correlated. In a real market, you will be happy to find something that is only uncorrelated. In modern financial markets, you will never see the case that two assets are completely negatively correlated, with maybe one exception. If you have a stock, and if you have a financial derivative with this stock as the underlying, sounds perfect, sounds like a free lunch. Problem is, what if we leave out transaction costs? So it might be that you find two assets that are perfectly negatively correlated with each other, but then obviously market participants' transaction costs will kick in, and the expected return, which then becomes a deterministic return, will be 0 or negative. Now, we've seen this already on the plot. Now we can calculate the general formula for any non-perfectly correlated security. Again, you will get the MVP here, the minimum variance portfolio, and you will have the portfolio return, and then obviously you will have a plot that looks like this, somewhere in between the two extreme cases. Okay. This was the two security case. Now let's generalize this to n securities, 10, 12, 15 stocks. The portfolio return again is given by the weighted sum of the individual assets returns with weights xi, x1, x2, x3. Now, we could also impose something that we say for 3 stocks, for example, we have x1, x2, and then 1 minus x1, x2. That would reduce the number of parameters by 1. But here in the n security case, we'll just deal with n parameters. We assume that xi is larger or equal than 0. And in, I would say, 100 or 150 slides, way down the road on this lecture, we will see a practical application in MATLAB with real data, and you will immediately see that the plots I've just shown you with the minimum variance portfolio, the set of possible portfolios, they are actually you can only achieve these risk return profiles if you allow short selling. And this is one drawback of the Markowitz portfolio theory, that in practice you will need extreme portfolio allocations and short selling to achieve all this. In theory it works, but in practice you need short selling. But we assume no short selling, and we have to spend all our money, so we have 100% invested in total. And again, the portfolio return and the portfolio variance is just given by the general formula for the expectation and the variance of a linear combination of n random variables. So the weighted sum of the expectations of the individual assets and the portfolio variance. You might remember this. In this case, you need a variance covariance matrix. You do not only have the two variances and one covariance or correlation, but you also have all the other covariances between 1 and 2, 1 and 3, 2 and 3, and so on. This is why you have this very weird looking sum. It only means that you have to take all the sums for I smaller than j. And you have these two indexes, I and j, and you have to calculate all those different correlations. Why do you need this? Because the correlation between 1 and 2 is the same as between 2 and 1. How does a correlation variance-covariance matrix look like? Well, you have the maybe that's interesting as well. On the main diagonal of a variance-covariance matrix, you will have the covariance, or the correlation, or the covariance, between 1 and 1. And the covariance between 1 and 1 is the variance. So on the main diagonal, you will have the variance, and the other entries are the covariances. But this is a symmetric matrix, so we don't have to look at these entries. You only have to look at the upper triangle of this matrix. So it's okay just to go 1, 2, 1, 3, 2, 3, and you're done in this case. Okay. Let's look for some time at naive diversification. N securities, we just invest 1 over n, 1/nth part of our investment sum in each and every investment, in each and every security. Now, for a broader analysis of naive diversification, we look at the following average quantities: V bar of n and C bar of n. V bar of n is what? The average variance. C bar of n is what? More or less an estimate of the average covariance. And what can we see? Let's calculate the variance of a naively diversified portfolio. Then you will see this is given by the sum of 1 over n squared times the individual variances plus the sum of 1/nth times 1/nth times the covariance between I and j, and all of these covariances, weighted covariances, are weighted and summed up. And if you rearrange this with these average quantities, you will see that this is nothing but the average variance minus the average covariance weighted with 1 over n plus the average covariance. Now, one would think that if I were only to buy into 1,000 stocks, I will be able to diversify my risk to a portfolio risk of 0. If I have 1,000 assets, one would naively think, well, only by including more and more and more assets in my security portfolio, I can reduce risk to 0. Well, no. If n goes to infinity, this here goes to 0, this here becomes 0, but in the end, the portfolio variance is what? C bar. So if n approaches infinity, the variance of this naively diversified portfolio still remains at the average covariance. So without looking at the covariances and the correlation structure between the individual assets, naive diversification brings you nothing. You need to exploit the correlation structure between the individual assets. Yeah. So this is what we later on will call the systematic risk of the market or the portfolio. You cannot reduce your portfolio risk to 0 beyond systematic risk. And this is a famous example. I've already talked about the efficiency of the portfolios. And if you've heard about portfolio theory by Markowitz yet, you know that, well, if I have 2 stocks here and the minimum variance portfolio, and it looks like this, okay, here, that's the MVP. Well, we know that we don't need to bother about these portfolios. Why? If I take this portfolio here and compare it with this portfolio. Both will have the same sigma, the same variance or volatility, but this portfolio here will have a higher return than this one. So we'll choose this and not this. And this means that later on the frontier of efficient portfolios will look like the famous eggshell. In German this is also called die halbe Eierschale der Portfoliotheorie. Very interesting image here. And this is the set of efficient portfolios. All the portfolios on the downside, on the downward slope of this line, this curve, all of these portfolios are dominated by by one portfolio on the upper half. So this is Markowitz efficiency, expected mean variance efficiency. If you have the same expected value, choose the portfolio or the asset with the lower volatility. If you have the same variance, the same volatility, choose the asset with the higher expected return. Yeah? That's also referred to mu sigma efficiency or mu sigma dominance. It's the efficient edge or the efficient frontier. Again, remember, for rho smaller than 1 and larger than -1, you will have a curve and not a line. And this is what will happen here. You have 3 assets, A, B, and C. By combining these assets, you might also be able to get somewhere here, so you will move away from A and C, but increase the size of the set of possible portfolios. But again, somewhere here you will stop. This is obviously the minimum variance portfolio, and you can disregard this part. That's not part of the efficient frontier. Now let's look at this formally. Portfolios of the efficient frontier can be determined as following. For a given constant expected return, the volatility of the portfolio is minimized. So we are looking at the secondary condition that given a constant portfolio return and given the requirement that all the weights add up to 1, we need to minimize portfolio variance. And the minimization can be done with the help of the Lagrange method. Is everyone familiar with the Lagrange method? Yeah? Okay. In practice, in reality, this is a simplification and even an oversimplification. I only assume that I want to have a certain minimum expected return, and I now minimize my portfolio volatility. Problem is that obviously in practice I will have additional conditions and requirements I have to fulfill. For example, it could be that I have internal restrictions. I'm not allowed to invest in certain assets. I'm not allowed to invest more than, say, 20% in stocks. For some companies, there might be legal and regulatory requirements. As you probably know, insurance companies are not allowed to engage in too heavy risk-taking, so they cannot simply invest 100% in stocks. They should invest a large proportion of their investment sum in risk-free assets or almost risk-free assets. And this makes optimization a little bit more complicated. Then the efficient edge shows an intuitively very plausible principle. Risk and the rate of return, risk and return always go in parallel. If you want a higher return, you need to accept higher risk. Otherwise, you would get a free lunch, or you would unnecessarily lose money, even give someone else a free lunch. So this is why the efficient frontier marks all those portfolios as inefficient if you have the same variance and different returns and expected returns, or the other way around, vice versa. Okay, and later on we'll use convex and non-convex optimization to solve for this. And this will get quite difficult, and this will get quite tricky. Why? Because we have many constraints, no short selling, certain maximum investment, requirements on which asset classes we can invest into, other requirements by law. If we do this, it's a little bit simpler to maximize and to optimize with respect to the amount of money you are trying to invest, because then you can assume that it's almost a continuous optimization problem. But actually, you would try to invest in a number of stocks, and then it will become a discrete optimization problem. And this will be discussed later. Okay, so this is the basis of portfolio theory. We'll see this later on, and we'll extend the model to the capital asset pricing model. The capital asset pricing model is one example, and the most famous example, of an asset pricing model that tries to explain in equilibrium asset prices, and which as a special feature extends portfolio theory by including a risk-free investment. And as soon as you have a risk-free investment, things change. You will no longer choose between asset 1 or asset 2, or a portfolio of asset 1 or asset 2, but you will choose one particular portfolio that gives you the best risk-return combination compared to the risk-free rate, and you will get to a very famous separation result, the Tobin separation, that tells you that you will no longer choose the portfolio that suits your risk aversion personally, but everyone will invest in one portfolio and choose a combination of risk-free investment and this single portfolio. So that's basically the result of chapter 3. Has anyone ever heard of the Tobin separation? Yeah? I can show it in one simple plot. Always remember that two investors will have two different risk aversion types and two different types of risk aversion. Let's assume you're risk friendly, you're risk loving, someone else is risk neutral, someone else is risk averse. Those three investors will choose three different portfolios on the set, on the efficient edge of the portfolio set. In practice, this would mean that I cannot delegate the decision to invest. I would need to know your risk aversion. And if I were a portfolio manager, I would have to ask each and every one of my investors, are you risk loving? Are you more risk loving? Are you risk averse? Are you highly risk averse? And so on. Now, as soon as I have a risk-free rate here, a risk-free investment, what happens is I can combine the investment in the risk-free bond and the portfolios, and suddenly the efficient frontier, or actually the combinations, no, this is not exactly perfect, the combinations of the risk-free investment and a portfolio will look like this. And we have a tangent portfolio here. So here. And the result then here is, in the Tobin separation, that now every investor buys the same portfolio, because all the other portfolios are dominated by a combination of risk-free investment and this tangent portfolio, this tangential portfolio here. Portfolio. And this is the theoretical basis of asset management and active fund management. It means that we, as an investor, we can delegate asset management and portfolio management to a manager who no longer has to decide on which risky asset he should buy. He should buy the tangent portfolio. Our decision only is, do we want to invest 50 euros in a portfolio, or 100 euros into the portfolio, will only decide on the question whether we should invest risky or risk-free. And that's what each and every one of you does. You take a part of your money and put it in the bank, and the rest is given to a fund manager, to an asset manager, portfolio manager. And the portfolio manager will buy the tangent portfolio. And in the CAPM, the capital asset pricing model, the tangent portfolio turns out to be what? The market portfolio, by the market. That's the basis of passive portfolio management. Buy the market portfolio, buy the S&P 500, buy the DAX 30, and be done with it. And it's called Tobin separation because the decision how much you want to invest in a risky asset and what risky assets you should buy in your portfolio. These two decisions can be separated, and the portfolio decision can be delegated to a portfolio manager. Okay. So that's chapter 3. Let's continue with 2.4. The numerical solution of a linear system of linear equations, German lineare Gleichungssysteme. Actually, in economics, you will see this at numerous times and in numerous places. I guess there are not too many direct applications outside of supply chain management and production management, where you have production plans and you will see these systems of linear equations. But you will see this many times as an intermediary step in calculations, in statistics, in optimization, in option pricing. Every now and then a system of linear equations will pop up. And I want to show you what can go wrong and what problems may arise if you solve for a system of linear equations. A system of linear equations is simply given in this matrix form here, A times X equal to B. A is a matrix, X and B are two vectors. A is the coefficient matrix, X is the solution vector, and you have a coefficient vector B. Very simple. Now, we need to analyze especially the condition of this problem. We need to calculate the so-called condition number. Remember what the condition number was, die Konditionszahl eines solchen Problems. The condition number sigma was norm of fx minus f of x bar divided by the norm of fx is smaller or equal than sigma, the condition number, times the norm of x minus x bar divided by x. What does it mean? Does anyone remember? What's on the left-hand side? What's on the right-hand side? Yeah? Mm-hmm. This is the relative input data error. X is the true data. X bar is the data including an error. That's the input data. And by taking the difference between true and false data divided by true data, you get the relative error in the input data. On the left-hand side, you have the error after applying the true algorithm and the best working algorithm. So what you will see here is simply the amplification of the input data error times a number sigma in case the algorithm does its best work. We have no additional, for the condition number, we have no additional error introduced by an erroneous algorithm. But if, for example, x bar would be 0 or would be x, then we would get the exact result we should get. Yeah? I hope I'm not stressing this too often, but remember two sources of errors. Yeah? The algorithm can introduce an error, and the input data can already have an error. So it might be that you calculate in a correct way, but with erroneous data, or you calculate with true data, but your algorithm is false. So these two sources of errors we have, and the condition number simply shows how the input data error is amplified in this particular case, even if you use the best algorithm and the true algorithm. Now, in case of real numbers, usually you will have the regular norm, that's just the absolute number and the absolute value of, say, 4 or minus 4. We generalize this in mathematics to metrics and norms, and actually here we need the norm of a matrix and the norm of a vector. One of you studying mathematics, right? You, yeah. So you know this. Norms and metrics are very general concept in topology. In mathematics, you are thinking in very abstract ways. You're thinking of spaces, of vectors in 3, in n dimension, and so on. You're thinking of spaces and sets of functions, and you want to structure these mathematical spaces. And one way to structure any type of space, mathematical space, of mathematical objects, numbers, vectors, matrices, functions, etc., one way is to find one point where you have a natural zero, natürlichen Nullpunkt oder Ursprung, and to calculate distances between two objects and distances from one object to the natural zero. In real numbers, this is quite clear. Yeah? If you have the absolute value of 4, it means the 4 as an object is 4 points away from 0, or 4 numbers away from 0. And the absolute value of 5 minus 3, that's the distance between 5 and 3. Regardless whether you have 3 and 5 or 5 and 3, it's simply the distance. And if you generalize a norm or this absolute value, you will get to the concepts of norms and metrics. A norm is what? A norm is simply the distance to the zero and Abstand zum Ursprung. And a metric is the distance between two objects. So you can also calculate the distance between matrix A and matrix B, the distance between function A and function B. And you can imagine that here in these applications you need metrics and norms to calculate errors. We have a true function and an approximate function. We have a true matrix and an estimated matrix, and we want to measure the distance between the true value and the true object and the estimated object. So we need a norm for vectors. Generally, we have three requirements. First of all, for any object that is not 0, the norm should be unequal to 0. It should be larger than 0. Second requirement is, if you scale it away from 0 5 times, the distance should also be 5 times the initial distance. And the third requirement is, if you have two objects, it's always well, let's put it this way. You have the 0 here, and you have x and y here. And the idea is that it's simpler to go from 0 to y than to go to x and then to y. That's why the third requirement here is called the triangular requirement, the triangular inequation, die Dreiecksungleichung. If you were to take the absolute value, it would make sense. If you think of vectors in geometry, it also makes sense. Yeah? I'll say this in German again. Dreiecksungleichung hat man fast überall. Es ist immer einfacher, direkt von 0 zu einem Punkt zu gehen, als über irgendeinen dritten Punkt, über das Dreieck. Ja? Und das ist genau diese Bedingung hier. Für eine Norm haben Sie 3 Anforderungen. Alles, was nicht die 0 ist, hat einen Abstand zum Nullpunkt, der größer 0 ist. Wenn Sie 5-mal von diesem Punkt, oder wenn Sie irgendein Objekt haben und Sie verschieben den um das 5-fache weg, dann ist der Abstand genau das 5-fache und die Dreiecksungleichung. Also zu einem Objekt von 0 hingehen ist immer einfacher oder hat immer einen geringeren Abstand zu 0, als wenn Sie über Ecke gehen, ja, über Kante spielen, Bande spielen. Aber halt nicht nur für Punkte, sondern für Matrizen, für Vektoren, für Funktionale, für Funktionen, für Operatoren, was nicht alles. Deswegen, das ist in der Mathematik, in der Topologie ganz, ganz allgemein gehalten. So. Kann man sich am Anfang nicht so vorstellen, aber bei Matrizen sieht man das relativ schnell. Sie kennen das auch aus der Schule. First example, LP norms. You have a vector x1, x2, x3, and so on, and LP norms are defined as the pth root of the sum of the pth power of all the entries in the vector. And three famous examples. The L1 norm, the sum of all absolute values of all the vector entries. The L2, or so-called Euclidean norm, die euklidische Norm, the square root of the sum of squared entries in the vector, and the L infinity norm, die L unendlich Norm, just the maximal absolute value. Couple of things are in order here. You know this. In high school, you probably have taken the Euclidean norm and used the L2 norm in algebraic geometry. At least I did this in high school already. Calculated the Euclidean norm. And you can understand why we are using these norms, because these are basically error metrics. The L1 norm gives you what? The sum of the absolute errors later on. The L2 or Euclidean norm is what? Remember regression analysis. This is the sum of squared errors, like in an ordinary least squares regression analysis. And the L infinity norm is what? The maximum absolute error. Three different types of estimating an error between two objects. We can calculate this quite easily in MATLAB. You just take a vector v, and then you can take norm v, comma 1, norm v, comma 2, or norm v, comma inf for infinity, and it will calculate the L1, L2, and L infinity norm. And remember, this is a norm, and you can create a so-called norm-induced metric, eine Metrik, die durch eine Norm induziert wird, by taking the norm of V1 minus V2, and then this will be called a metric. And you can hear from the sound of that error metric, Fehlermetrik. This gives you the distance between two objects, and if you get the right object, if you calculate an object correctly, the metric, the error will be 0. Otherwise, you will have the L1, L2, or L3 error metric. Okay. The sum of the absolute errors, the root of the squared error sum, or the maximum error. That's the L1, L2, or L infinity metric. Same goes for a matrix. Matrix, again, you need the norm of a matrix should be larger than 0 for any matrix that is not the zero matrix. If you multiply it with a scalar c, the distance will grow by a factor c, and the triangular inequation here in the third line. With a matrix, it is a little bit more difficult to understand and to think of it in geometric terms, but it's basically the same principle. You have matrices as mathematical objects, and you want to calculate the distance to the zero matrix, or the distance between two matrices. Okay. With matrices, we also have the L1, the L2, the L infinity norm, the so-called Frobenius norm, that is slightly different. And you can see here, with the L2, the Euclidean norm, you need the so-called spectral norm, or the spectral radius of a matrix. Has anyone of you seen, maybe in linear algebra, the spectral radius of a matrix? Might be that our colleagues from the Math Institute also teach this in our Math for Econ class. No? Yeah, okay. Let me just shortly recap this. The spectral norm is the square root of the spectral radius of A transpose times A. What is a spectral radius? The spectral radius is the maximal absolute eigenvalue of a matrix. It's really called an eigenvalue, like the German word eigen. And it's also related to the eigenvector of a matrix. What is an eigenvalue and an eigenvector? If you have a matrix A, what is an eigenvalue and an eigenvector? A times, you should know this.
A times a vector is equal to the eigenvalue, let's say lambda.
Yeah, lambda times the eigenvector. Yeah. Meaning that, just look it up on Wikipedia actually. The eigenvalues and eigenvectors of a matrix have a lot of applications in linear algebra, and you can also interpret this, but this simply means that if you have a vector u, and in linear algebra terms, a vector and a matrix that is multiplied by a vector means that it's somehow rotated, shifted in, let's say, three-dimensional space. Always think of it in 3 dimensions and geometrically. Then a 3-dimensional vector times a matrix is nothing but a vector that is scaled, shifted, rotated, etc. Very simple. And an eigenvector is a vector that if it's multiplied with this matrix is just the same vector, a little bit longer or a little bit shorter. It's not rotated, it's not shifted, it only slightly stretched, or the other way around. And there are several more applications and ideas how you can interpret this. But this is the these are eigenvalues and eigenvectors. And the eigenvalues correspond to the eigenvectors. And then you get the spectral radius, and the spectral radius gives you even more information about this matrix. Now what do we next need? We need compatible norms. We have norms for matrices and we have norms for vectors. And we call these two different norms compatible if the norm of A times X is smaller or equal than the norm of A and the norm of X, with two different norms. Then we call these two compatible. Much ado, well, not about nothing, but we need a lot to talk about a simple result now. Think of this system of linear equations, AX equal to B. We are now including an error in the input data, x plus delta x, and b plus delta b. Put slightly differently, a times delta x is equal to delta b. That means delta x is equal to a inverted times delta b. So we need compatible matrix and vector norms. So with compatible vector and matrix norms, we get the following result. Divide both sides by the norm of x, and this means that the norm of delta x divided by the norm of x is smaller or equal than the norm of A times the norm of the inverse of A times the norm of delta B divided by the norm of the vector B. In other words, what is this? Relative output error, relative input error, and this is our condition number, sigma. So if we have a system of linear equations and we include an input data error, delta B, we have to assume that we will not get x, but we will get x plus delta x. And the condition of this problem is expressed in the norm of A times the norm of the inverse of A, showing that also the invertibility and the ease with which we can calculate the inverse of A strongly influences the amplification of an input data error in solving a system of linear equations. Sounds very theoretic, so this is the condition number, but you can immediately see it in this simple example. A is 1, 0.6, 0.3, and so on. This is a matrix A. Cont A gives you the condition number in MATLAB. Condition number is 30. Circle. Then we take a three-dimensional Hilbert matrix. In the first lecture, we saw that the Hilbert matrix is extremely badly conditioned. Well, condition of B is 525. Matrix looks harmless at first, but the condition is completely different. It's much, much higher. And if we solve a system of linear equation with A, regardless of what algorithm we use, A will get a much better result than using the second matrix B, simply because errors in the input data of the vector B are amplified by this matrix. Yeah? Remember, the error in this problem is not in A. The error is in the vector B, and we haven't talked about B yet. Simply by the fact that this matrix has this special structure and a bad condition number. Solving a system of linear equations by using this matrix B will amplify any error that is in the vector B that hasn't even been clarified and specified. Okay. Now one can solve these problems by converting this problem a little bit, but we'll talk about this the next time. Do we have any questions? Doesn't seem to be the case, so thank you very much for your attention and see you next time.